Ever hear of a credit stack? No, it's not a puzzle or something you pack for lunch. It's simply a combination of funding tools a business can use to support its operation and growth. And if you're a small business owner, it just might be the piece that your business is missing. In this video, we'll talk about what a business credit stack is, how different funding options can work together, and why many businesses use more than one type of funding over time. Hi, I'm Nimaj, a business credit coach with NAV. Let's jump right in. First, let's define what we mean by a credit stack. A business credit stack isn't a single loan or credit account. It's a combination of funding options that serve different purposes within a business. For example, a business might use trade credit with net-30 payment terms, a business credit card, a business line of credit, and at some point, a business loan. Each financing tool can play a different role. The goal isn't to collect as many accounts as possible. The goal is understanding which financing tools best support your business needs. Let's look at 4 common pieces of a business credit stack. Number 1, trade credit for purchasing supplies. Trade credit is often one of the earliest funding tools businesses encounter. It allows businesses to buy goods or services from vendors now and pay later under payment terms such as net-30, net-60, net-90, meaning payment is due 30, 60, or 90 days after the invoice date. Trade credit can help businesses purchase inventory, materials, or supplies while managing cash flow. Some vendors also report payment experiences to business credit bureaus, although not all do. Number 2, business credit cards for everyday expenses. Business credit cards are commonly used for routine operating expenses, such as fuel, travel, office supplies, software subscriptions, advertising. Business credit cards can provide spending flexibility and may also offer rewards or expense tracking features depending on the card. Number 3, business lines of credit for working capital. A business line of credit is often used to manage temporary cash flow gaps. For example, a business may use a line of credit while waiting for a customer to pay invoices or when unexpected operating expenses arise. Unlike a loan, businesses generally draw only on the amount they need, up to their approved credit limit. Number 4, loans for larger investments. As businesses grow, they may consider loans for larger financing needs, such as equipment, business expansion, commercial vehicles, facility improvements, major projects. Loans are generally designed for larger investments that are repaid over a longer period. Rather than replacing one another, these financing tools often serve different purposes. Here are 3 mistakes small business owners should avoid. Mistake number 1, opening accounts without a business purpose. Some business owners believe they should seek every funding option available. Instead, funding should support a legitimate business need. The right financing strategy is often based on how businesses operate, not on how many accounts it has. Mistake number 2, taking on more credit than the business can manage. Every funding option needs to be repaid. Businesses should evaluate whether future cash flow can realistically support those obligations before borrowing. Responsible use of credit is just as important as access to credit. Mistake number 3, not knowing the difference between financing options. Vendor credit, business credit cards, lines of credit, and loans all work differently. Choosing the right funding option often depends on the purpose of the funds, the repayment timeline, the business's cash flow needs. Understanding these differences can help businesses make more informed financial decisions. Many business owners ask, should I build my credit stack in a specific order? There isn't one path that works for every business. The right financing strategy depends on factors such as business stage, revenue, cash flow, financing needs. Some businesses may begin with vendor credit and business credit cards. Others may qualify for a line of credit or a loan earlier based on their financial profile. Rather than focusing on a specific sequence, it's often more helpful to focus on using the right financing tool for the right purpose. Let's recap. A business credit stack is simply a combination of financing tools that work together to support business operations. Those tools may include vendor credit, business credit cards, business lines of credit, business loans. Each funding option serves a different purpose, and many businesses use more than one as they grow. The goal isn't to build the biggest credit stack. The goal is building a funding strategy that supports your business's needs while managing repayment responsibly. Sign up for a NAV Prime membership at nav.com to monitor your business credit profile, explore financing options, and make more informed decisions about which types of financing may fit your business. If you found this video helpful, be sure to like, share, and subscribe for more business building tips. Thank you for watching. See you on the next one.